From New York City, for our viewers worldwide, I'm Alix Steel in for Jonathan Farrow. Guess what? Good labor news is actually good news for the market and a bull steepening in the curve. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, U.S. payrolls topping estimates while wage growth starts to cool, lifting futures higher, sending Treasury yields lower as the market prices out a final rate hike for this cycle. We begin with the big issue, payrolls in America.
We're watching the labor market.
The payrolls number.
Non-farm payrolls.
The relevance of non-farm payrolls on Friday simply can't be overstated.
The key data point we have to be watching is the labor market and specifically wages.
If you look at the economic data, I mean, it just keeps coming in showing a tight labor market.
A very strong, tight labor market.
We're starting to hear a little bit more in terms of softer employment.
We already know that the job market is slowing.
Jobs are cooling.
Cooling off a little bit. I think that the Fed's got to be quite encouraged by that.
That may get the attention of the Fed.
The question is this the data point that Fed needs to get near the end of the tightening cycle?
We're going to have to try to read what the underlying trend is in data.
I think that the jury's still out as to the ultimate direction of the economy. And labor, for that matter.
Follow the labor market.
Labor is key as we head into Labor Day.
Joining me now to discuss, BlackRock's Rick Reeder. Rick, I was super pumped. I get to talk to you. It's been way too long.
Hey, Alex. Yeah, I agree. I thought the same.
Good to see you. Hey, what's your reaction? The market's taking it as a Goldilocks report. What do you think?
It's a good report. I mean, for the Federal Reserve, it's a pretty good report. I mean, you're starting to not just. In fact, the unemployment rate's ticking up a little bit, but it's ticking up for the right reasons that you're getting this significant 736,000 people entering the labor force, I think Mike McKee pointed out. But, it's interesting when you actually dissect it further, you're seeing some things. The cyclical parts of employment are clearly softening. I saw transportation, temporary hiring is down again this month. But, you see things like healthcare and education, which are not cyclical, continue to have a firm tone to over 100,000 jobs again. So, listen, I think it's pretty good. It is, and obviously wages coming down is significant. I think you can use this as another benchmark for the fact that we're seeing slack build in the labor force. We're seeing employment. What has been an unbelievably hot employment market, labor market, is coming off a bit alongside of inflation coming down. So pretty constructive.
Yeah, that is a really articulate way of saying Goldilocks. Hang tight, Rick. Let's get into the details. Michael McKee joining us with the latest on the payrolls. Mike, you're digging through. What do you have?
Well, Alex, the initial print looked pretty good, 187,000, but that comes after 110,000 were subtracted from the month before, leaving July at 157. So it isn't as strong in terms of job growth. The net revisions of 110,000 down. Unemployment rises. And skip over hourly earnings for just a second and look at the labor force change. That's why unemployment rose 736,000, as Rick was just mentioning, after 152,000. Fed's been waiting for that to happen, people to come back into the labor force and help push unemployment up, and that is what we saw. But we did see wages not rise as much on a sequential basis, up 0.2% after a 0.4 the month of July, and that pushes down the year over year. The Fed is going to be happy that we're seeing a little bit of slowing in wage growth. Now, the numbers relatively weak, I said, but take a look at why. One of the reasons that we have seen a big drop is that the Yellow Company went out of business, and 37,000 trucking jobs were lost. You can see the drop there. If you add the 37,000 into the 187, you'd be well over 200,000, and that would be reasonably good news, or bad news, depending on how you want to look at it. Where the jobs aren't also shows us something. Motion picture and sound recording. This is the SAG after strike. Subtracted 16,800 jobs, almost 17,000 jobs. State and local education, teachers go back. Everybody goes back in August, but they didn't, according to this. So there's a seasonal adjustment issue. Leisure and hospitality still gaining a lot of jobs, and construction, surprisingly, even though it's busy out there for new home builders, construction jobs up 22,000. They found people who could do do the work. So good news for home builders, but it also suggests that we have sort of this Goldilocks report where you've got some good, some bad, rising unemployment rate, lowering earnings, and the Fed's going to like that.
Mike, great breakdown. Really appreciate that. Atlanta Fed President Raphael Bostic making the case for some patience, saying today that based on current dynamics in the macro economy, I feel the policy is appropriately restrictive. I think we should be cautious and patient and let the restrictive policy continue to influence the economy, lest we risk tightening too much and inflicting unnecessary pain. Hey, Rick, does that equal we're going to pause in September and then TBD November?
I mean, I think so. I mean, I think the Fed should be done. I certainly think, given this number, unless you got something very significant on CPI, I think they're not going in September. Listen, I think when you dig in, and there's something that's really important, and this number embodies that. Why do 736,000 people come back in the labor force? The lower income strata in this country are having a tougher time.
Yeah.
You see that in terms of, by the way, look at the earnings reports from the Dollar Generals, et cetera. The lower income strata is having a tougher go. You see credit card balances rise. Listen, I just think we're seeing, when you lift rates this much, you benefit the higher income, who are the savers, and you hurt the borrowers. I think Tom Keene was saying, look at where mortgage rates are. I think the Fed should stop.
Okay.
And I think we're at a place, and today certainly gives them further information or justification for that.
So, Rick, do you buy the front end on that?
I mean, we like the front end of the curve, and we've been talking about on TV for a while. We like holding, the front end. I mean, you get paid if you buy CP, et cetera. You get paid 6%. It's been incredible, or about cheap as 6%. It's incredible carry. But I think now that you can actually extend that a bit further on the curve. We talked about, I think, last month, and we've been adding some out to the belly of the curve because you're pricing in, if you believe the Fed is done, and you're not paying a lot for the forwards because the markets have priced out a lot of those cuts, that you can actually extend a bit further out the curve today, lock in some of these yields, not just in treasuries, but in parts of the credit market, mortgage market, securitization market. So I think you can put your shoulder behind a bit more of interest rate exposure than has been the case certainly over the last few months.
So what do you do with the long end? Where's going to be the top, say, then for the 10-year?
Not a lot is to in terms of what do you do with it. I think the very back end of the curve, unless you're a pension fund, a life insurance company with an inverted yield curve, it's not a hedge to risk, because if inflation is higher, it's going to hit risk and the back end of the curve. I don't think it's a lot to do with it. And like I say, unless you're defeasing or you're matching a liability as a pension or life insurance company. So I think, listen, I think hiding it, it's not hiding, clipping an awful lot of yield in the front to the belly of the curve makes sense. The 10-year is sort of, do I think rates can move a bit higher from where they are in the 10-year point? I still think they can go a bit higher. They strike me. Do you have some interest rate exposure out to the 10-year? Maybe. Like I said, I don't really like going further than that. But I certainly prefer being in the front to the belly and just holding that carry.
When do you want to buy the 10-year, Rick? Are we looking at 4.5? At what point you're like, okay, I'll pull the trigger? So,
by the way, owning some, I would say buying some recently. Owning some 10-year notes is not crazy. And could you go to 4.25, 4.5? It's certainly a possibility. When do you want to grab more duration, more interest rate exposure? When you think the Fed is now shifting into more of a easing cycle. Listen, maybe when you parse what Chair Powell said at Jackson Hole, he gave a lot of data for what would cause them to hike rates. They're still in a mode of inflation above target, and we're certainly not in a mode of it's time to ease, even when you, as you say, Bostic's comments about it's time to pause, which I agree with, but they're not at a place where it's time to ease. When that starts to manifest itself, gosh, do you grab for more duration further out the curve and other parts of the curve? I think so. Again, the one point I would make, when they do that, the yield curve is going to steepen. So this is part of this idea, do you need to go, how much duration you have to have far out the curve, but adding some interest rate exposure, definitely.
So I'm looking at WIRP, Rick, and it looks like we're still pricing in May for that first cut. Is that in line with how you guys are thinking about it?
Yeah, I still think you have to consider that the second half of the year may get to, I guess, close enough. But I still think it's a second half of the year. I think this Fed would like to see a persistence of inflation under target. They'd like to see some more slack in the labor force to give a sense that you've really bolted down the durability of lower wages, lower inflation. And I think that takes a number of months to get that data for them to feel really good about that data. So I think we're like part of why I like taking a bit more interest rate exposure. When you get to May, June, July, et cetera, now you're getting in a place where you have enough data to build your confidence set. And so I think that's about right at this point.
Hey, Rick, I don't want to open like a ginormous can of worms, but is it the same narrative when it comes to Europe?
That is a Janet. So
you got 30 seconds. No, I'm kidding.
Europe is really different. Europe, you're still well above the inflation target, and growth is challenging. You look at the data in Germany. That is, I mean, boy, it's some of that's a derivative of the impact from China. You see that through manufacturing. Now, by the way, you look at the UK. Looked at the housing data today in the UK. I mean, Europe is slowing. I think that you'll start to see these inflation numbers start to fall, but they're still well above what is a normalized inflation in Europe. So, how you think about your interest rate exposure in Europe and where on the curve you hold it has to be a slightly different set of expressions than you would do in the U.S. because it's a very different economic paradigm relative to inflation.
Yep, it's not synchronous anymore in that respect. Hey, Rick, really good to catch up with you. Thank you for joining. Rick Reeder joining us from BlackRock. All right, let's take a look at some of the stocks ahead on the opening bell. Simone Foxman joins us now. Simone?
Yeah, Alex, set aside some of the impact of those job numbers. We got a really strong slate of earnings out after the bell yesterday from some tech companies. Dell beating its expectations, boosted by its AI server business, especially the partnership that it has with chipmaker NVIDIA. PC sales also better than expected. COO Jeff Clark encouraged by the macro environment, especially in June and July. MongoDB, the database software company, shares rallying 4.6% in the pre-market after EPS came in really double the expectation. A beat and a raise there. And finally, a beat and a raise for Lululemon. High-end consumer is strong. We're seeing shares rally as Stifel, JP Morgan, BMO, all lifting their price targets.
Yeah, you buy the yoga pants, but apparently not Dollar General. All right, Simone, thanks a lot. Coming up, the U.S. payrolls report taking some pressure off the Fed.
The labor market holds the key to whether you can pull off that soft landing. So continuing to see businesses add jobs, that's helping in terms of consumers' income and therefore their own spending, while giving time for some of those supply side issues from the pandemic to unwind. And I think the labor supply story is very much a part of that.
More on the latest jobs report with iCapital's Anastasia Amoroso and PGIM's Michael Collins. That conversation next. This is Bloomberg.
I think you can use this as another benchmark for the fact that we're seeing slack build in the labor force. We're seeing employment, what has been an unbelievably hot employment market, labor market, is coming off a bit alongside of inflation coming down.
The U.S. economy adding more jobs than expected in August. Non-farm payrolls coming in at 187,000. Unemployment rate rising to 3.8%. Wage growth cooling, underscoring a strong labor market that is coming into balance. iCapital's Anastasia Amoroso and PGIM's Mike Collins joins me now. Mike, let me just start with you because Rick Reeder, that was his take on the jobs number. And then he's like, let's go buy the front end, right? Is good news finally good news here?
Yeah, I think a slowing labor market, which has been in place really for most of the year now, is good news. The unemployment rate finally, that stubbornly low unemployment rate finally ticking up, I think is good news, but you have to be careful, right? The labor market can be a real slippery slope. Once it starts deteriorating, Alex, sometimes it deteriorates too fast. So you have to watch what you wish for, but we're definitely in that, weakflation, slower growth, moderating inflation camp, and that's good for risk assets.
All right, Anastasia, do you agree? Good news, good news?
I do. I think this is a very welcome jobs report, Alex, because, I like seeing the labor force participation rate tick higher because the Fed has been trying to solve this supply of labor issue as part of the labor market rebalancing. So the fact that that tick higher is really good news. And the unemployment rate, of course, is 3.8%. So on the surface, that's a negative number, but that's because people are entering the labor force and it's going to take some time for them to find jobs. And then you've got the wage growth that's clearly tapering off here, rising 0.2% month over month versus a little bit faster. So you take that together with the JOLTS number, the job openings that slowed to 8.8 million, I think the Fed is going to say this is clearly a labor market that is rebalancing. It is slowing. The momentum is not as buoyant as it used to be. And that's great news because it takes pressure off the Fed.
So I know it's going to come as a big shocker to everybody here, but Nouriel Roubini does see a correction in the global equity market if economic conditions do soften.
If the global economy is going to weaken, if there is still a meaningful chance of at least a bumpy landing, probably markets have rallied too much today, and that's maybe going to lead to a correction in the second half of the year. 10% correction is not totally unlikely if the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more. I would not be surprised if in the second half of the year they get a 10% correction in global equity markets.
Anastasia, do you think we'll see a 10% correction, and would you be buying it?
Well, first of all, on average, if you look at markets, you do tend to have a 10% correction every single year. And on average, you have a 5% correction every single quarter. So, I think the probabilities, are probably there. But I don't necessarily expect, that deep of a correction this time around, because in the second half of the year, by the way, we're in September, so we have about 4 months of the year left to go. And we have an economy that I don't think is about to slip in a recession because we're heading into September with very strong positive economic momentum and the Fed that is likely to press the pause button on the rate hiking cycle. So I don't see that economic deterioration being the trigger for it. And the other reason, Alex, I would say maybe 10% is a little bit extended is because there's so much cash on the sidelines. And if you think about why we can't even seem to have a 5% correction without it being bought, is because a lot of investors likely missed the very robust first half of the year. And so they're looking for a chance to get back in. So as long as the economy is not falling apart, which I don't expect, and as long as people need to reposition, I think a lot of these pullbacks will get bought.
Mike, it's a similar question when it comes to the bond market. Do you buy the front end then?
Yeah, it's I'm not as bullish on the very front end as Rick Rieder is. I think, meaning like the 2 and 3 year part of the curve. There are a lot of rate cuts, almost 200 basis points of rate cuts priced in over the next couple, 3 years. And that is really aggressive. That's really assuming the Fed can pull the soft landing off, that they can pivot aggressively. On the credit side, akin to the Anastasia's comments on equities, the markets are pretty fully priced, right? The markets are pricing in a really high probability of this very benign soft landing scenario. And even though that's probably the base case, wow, there's really a good chance that either one, rates stay unusually high, which hurts risk asset valuations, or you do tip into weaker growth. And you look around the world, right, Alex, and China is like unraveling, and Europe is moving into a pretty deep manufacturing recession. So you have to really be careful on buying risk assets here. And we're defensively positioned, looking to buy the dips.
Where, Mike? Where buy the dips defensively?
In credit in general, investment grade corporate bonds look expensive to us. High yield corporate bonds look fair value to maybe a little expensive. We've been buying, certainly bank debt, the senior debt of the banks, whether it's the big money center banks or the super regionals, which obviously got killed a few months ago. Those are opportunities you want to buy on the dips, and even high quality, high yield. If spreads are 50 or 100 basis points wider, which is not that big of a deal, I think you're supposed to buy into that.
Which I guess begs the question, guys, is, when we price in those cuts, why are we pricing them in? Are we pricing them in for normalization? Are we pricing them in because the economy is getting hit pretty hard? Anastasia, does that affect where you want to be putting then cash to work?
Yeah, Alex, I think at some point earlier this year, the cuts were being priced in because it was consensus the economy is going to have a landing and maybe even a recession, and the Fed is going to be forced to cut rates. And that's why we were pricing in quite a few rate cuts. But I think now that has shifted quite a bit, and we're on track for a soft landing and the economy that still chugs along. But the reason why the Fed would cut rates even under that scenario is because as inflation trends down towards 2%, if the Fed does nothing, the real interest rates is actually going to start to rise. And at the current juncture, Alex, I don't think the real interest rate is even restrictive yet, or maybe it's just on the cusp of being that. But if inflation falls, real rates go up, we are going to find ourselves at some point in a place above neutral. And that's what would potentially cause the Fed to cut rates. So I don't think the economy needs to fall apart for the Fed to do that. It's just the inflation needs to continue to slow.
Which brings us to, like, can we have a job-full slowdown? I was going to say recession, but let's put that out. Like a job-full slowdown. Mike, what do you think?
You know, the job market is starting to weaken in a lot of ways. Even today's number, that all those people that come, it looks like they came into the labor force, a lot of them were actually employed people who've moved onto the unemployment payrolls, and the wage gains are moderating. So I think you're going to see the unemployment rate tick into the 4s, and let's all hope it stays in the 4s, right? I mean, history, if it's any guide, is a not a good indicator for a soft landing. Typically, when the unemployment rate starts going up, you know, the end is nigh. So you really have to be careful there. But, you know, the economy in general is on decent footing.
And Anastasia, okay, so if Mike's kind of watching that 4% U3 level, what's the data point that you're watching to sort of tip the scales into a job-full slowdown?
Yeah, I mean, it's definitely continuing to watch layoffs. And I guess if we do have, several more months of, some layoffs that are starting to show up and the unemployment rate continue to trend up, maybe that does raise a question of whether that's kind of the first shoe to drop. I don't expect that to happen at the moment. And, Alex, I wanted to come back to kind of another point that we're all circling around, which is, yields at 4 or 5%. I think everybody's scared of this level and is saying the risk assets can't do well in that environment. But if you go back prior to GFC, the 10-year around 5% is the normal. So is it possible that we're just going back to that old normal where you've got inflation that's, certainly higher than it was post GFC, where you've got growth expectations that have actually picked up, and you've got the Fed that's going to keep rates around 5% for a prolonged period of time? I think that's exactly where we're going back to. And by the way, that's not a disaster for risk assets. If you look at the performance, prior to GFC, you've had corporate bonds that outperformed the Treasury market.
Anastasia.
You've had private equity that did well, and so did equities.
All right, we got to leave it there, guys. Anastasia Amoroso, Mike Collins, you were sticking with me, so hold that thought. Coming up, morning calls. Plus later, Deputy Secretary of Labor Julie Su joins us to discuss the August payroll report. That conversation right after the opening bell. This is Bloomberg. This is a countdown to the open. I'm Alix Steel in for Jonathan Ferrer. We're moments away from the start of trading. Louisville, Kentucky, apparently. That's where we're going to bring the nicey bell this morning. You had S&P futures up about 0.5%. The good news in the job market, good news in the equity market. That's holding firm. Switch up the board and let's just see where else we're trading here. So in the front end, you're seeing some strong buying in the bond market with yields kind of moving lower, and the back end kind of debating if we want to be bullish or bearish there. Dollar overall also weaker. And crude, I want to point out, the highest level that we've seen since November. Is that an economic demand story, or is that just potentially a weaker dollar story? But for now, good news is good news as the market opens on this Jobs Friday. All right, couple stocks to watch right here at the open. You got Broadcom and Dell, the two tech companies heading in very different directions after earnings. Chipmaker Broadcom delivering a downbeat forecast, while shares of Dell are surging amid signs of rebounding demand on PCs. Bloomberg's Ed Ludlow joins us now from San Francisco with more. Ed?
Yeah, good morning, Alex. Happy Friday. Two very different directions. Let's start with Dell. The stock trading at a record high now, on track for its biggest jump since March of 2020. The story is decelerating growth. Actually, revenue fell 13% year on year to $22.9 billion, but that was still ahead of Wall Street's expectations of around $20.8 billion. EPS, $1.74 a share in the quarter gone. The Street was looking for $1.14. It's the outlook that we go to. CFO Yvonne McGill saying that revenue will be $23 billion in the current quarter, which ends in October, way ahead of expectations. And there are signs that corporate demand, at least for both their PC and data center products, bottoming out. But we go to the AI story, and they call AI a long-term tailwind. And that is something that, if you look at the sell-side notes, they are buying into this Friday morning. Broadcom, a very different story, down 3% on Broadcom shares. They're seeing pretty slow growth, the slowest top-line growth in years. But the narrative from executives is that the data center specific chips relating to AI are gaining traction and they're seeing demand. Broadcom does two things. It makes the chips that allow for the transfer of data between specific computers within a data center. So when AI-related function or AI clusters are being built up in a data center, they should benefit. They also make custom silicon for some of the names in the hyperscale market that are building AI-specific data center. But realistically, you go straight to the outlook for $9.27 billion in the fiscal fourth quarter. The range of estimates from Wall Street were ahead of that on the bottom end and much higher on the top end. And the question is, why is Broadcom not able to take that demand it's talking about in AI and turn it into tangible revenue growth when NVIDIA is able to? They're the same story. It's just that Broadcom's not growing, and that suggests to us that its other parts and its other businesses, i.e. the Bluetooth Wi-Fi modem it does for Apple and other data center spending is uneven right now.
Yeah, and it just highlights when you get that NVIDIA quarter, like just how much maybe others are struggling to monetize that. Ed, thanks a lot. Ed Ludlow joining us. Let's stay with earnings for a moment. Shares of Lululemon moving higher after the retailer raised its annual forecast. The CEO striking an optimistic tone, saying, quote, our continued ability to gain market share illustrates the significant runway ahead. Bloomberg's Simone Foxman has more. Simone?
Yeah, Alex, Lululemon meeting or outpacing even by a slight bit all the metrics that Wall Street was really looking for. Comp sales up 11% year on year in North America, testament to the strength of that high-end U.S. consumer. Internationally, sales picking up as well. Sales in international markets rose 52%. Part of that was the China reopening. Part of that was store openings in China. International sales now constitute 1/5 of Lululemon's overall sales. That allowed the company to raise its expectations for revenue and profits for the year. For the full year, now sees net revenue $951 to $957 billion, or $9.51 to $9.57 billion, I should say. That's above the estimate from Wall Street. That was about $9.5 billion. Maybe the reason we're not seeing a bigger move here, though, up just about 2%, is because Wall Street was already extremely bullish on the stock.
No, fair enough. Simone, thank you very much. Let's turn now to a showdown in the media space, a contract dispute between Disney and Charter Communications, leaving millions without ESPN just as the college and NFL football season kicks off. A Disney spokesperson saying, quote, we are committed to reaching a mutually agreed upon resolution, and we urge Charter to work with us to minimize the disruption to their customers. Bloomberg's Isabel Lee has more. Isabel?
Hey, Alex. Minimize disruption indeed, and a lot of TV lovers aren't happy. So this all began because of a feed dispute. So Charter says Disney declined its proposal and pulled its video channels from Charter on August 31. So Charter says it's currently paying about $2.2 billion in annual programming costs to Disney, but only around 25% of its video subscribers regularly engage with Disney content. So Charter is the second largest TV provider in the U.S. It has around 15 million subscribers. And this is a big deal because, as you pointed out, sports season is underway, and this affects the likes of ABC Videos and ESPN. Media companies, though, have long fought over pay TV provider for years, and this often leads to contracts and some blackout periods. For now, both shares are down. You see Disney down around 3% and Charter also down around 2%. Both parties are said to be negotiating, Alex.
All right, Isabel, thank you very much. And finally, let's go to the automakers. Tesla back at it again, implementing yet another round of price cuts for their premium vehicles in both China and the U.S., making the Model X eligible for a government EV tax credit of $7,500. Katie Greifeld has more. Katie?
Hey, Alex. Yeah, there's not too much movement in Tesla shares this morning. They're down slightly, but some pretty interesting news across the lineup. We're going to get to the price cuts, but they also revamped their Model 3 sedan for the first time since they started production 6 years ago. That Model 3 now rated to go 377 miles on a single charge in China. There's also two new colors, Stealth Gray and Ultra Red. Very fun. But probably more consequential to Tesla's bottom line are those steep price cuts to the Model S and to the Model X in both the U.S. and China. Tesla now charging just below $75,000 for the base Model S and just below $80,000 for the Model X. That is according to the U.S. website. Now, for context, those vehicles came into 2023 with starting prices of almost $105,000, $121,000 respectively. Of course, we've gotten used to this from Tesla. They've been cutting prices in both markets all year, really, in an effort to boost sales that's been coming at the expense of profit margins. And it's a big question for Tesla how they continue to ramp up sales here. You wouldn't know it by looking at the shares. In 2023, Alex, up over 100%.
Katie, do we know what color Stealth Gray is?
I don't know what Stealth Gray is. It sounds like black if you really wanted to be stealthy, but the Ultra Red is Pretty cool.
No, totally cool. But you can't drive that in New York City. The stealth gray, I don't know, maybe. All right, Katie, thank you very much. We're just a few minutes into the trading day, the first trading day of September, because like, when did that happen? You're looking at upside on the markets here. You got the S&P up by 0.5%. Volume finally recovering after a dismal week of volume in the markets. We're going to see how long that actually goes. Consumer discretionary, energy, information technology, materials, all on the upside within the market. Okay, so let's get a little bit more in there. Let's get into the consumer discretionary. That's obviously going to be helped by Lululemon, doing pretty well. Etsy as well. All right, the 2-year yield is down by about 6 basis points, 4.80. So you're seeing the money come into the front end. The back end, though, isn't really sure what to make of this. You're seeing yields move a little bit higher here on the 10-year, 4.12%. Rick Rader not touching the back end. BlackRock overall was saying you got to see 4.5% on the 10-year before you want to think about buying. He does like the front. He does like the belly. And the idea is that the Fed can stop raising rates. There is enough pain in certain areas of the economy in order for them to stop, and the labor market seems to be holding up. Let's get back to those labor numbers. It is a solid market here. 187,000 jobs added, a 3.8% unemployment rate. I want to welcome our Bloomberg TV and radio audiences. I'm Alix Steel, and joining us now from Washington, D.C. is Julie Su, Acting U.S. Secretary of Labor. Secretary, pleasure to speak with you. Thank you for joining.
You too.
The market sees this as a good report. Good news is good news for the market. How long can this good news continue from where you sit?
Right, that's right. That's the right characterization of this, right? This is exactly what you'd want to see if you're looking for a soft landing. This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you want to see in a strong economy.
The one really big axe here, Secretary, is what's happening with the unions. You have the Hollywood strike still ongoing, the actors strike still ongoing. You have a potential auto worker strike that could hit the big three. You have trains, you have dock workers. There's a lot of union action right now. Is the White House in active conversations with these unions?
Right, so this is, we're continuing to see the effects of a tight labor market, right? We continue to have now unemployment at less than 4%. This is the longest stretch since the 1960s. And in a tight labor market, workers have more power. We've seen workers come back to the labor market and make choices about what it means to have a good job, a good family-sustaining job, a good job where they can, make demands to improve their lives and their working conditions. And the unions are a part of that. Now, you mentioned some unions where, through those demands, they've resolved issues that were longstanding, that have raised wages and addressed certain conditions. You mentioned the ports. That's one area. We saw that with the Teamsters and UPS last month. We continue to see workers making these demands, and these are not just like a sort of an accident in an administration that supports working people. This is really part and parcel of workers being able to demand their fair share.
Sure, but when you take a look at the auto workers, for example, how does the administration avoid Sean Fain as the head of the United Auto Workers overplaying his hand? The increases in demands that union is asking are tremendous. 45% wage increase, 32-hour work week, things that many say are very unrealistic. And if those workers strike, we could be looking at a recession. That's what some are saying. How does President Biden handle that?
Yeah, I mean, we have definitely seen wage increases in contracts that have been signed. We've seen them wage increases, over 6-year periods, right? Multiple year periods. I think for a president who believes, as I do, in the collective bargaining process, we trust the process, right? We allow the parties to stay at the table. They are staying at the table. That's a good sign. Parties are always far apart until they're not.
The Secretary, if they stay at the table and then eventually they strike, they don't get what they want, you're looking at 150,000 plus people out of work. That is going to have a tremendous drag.
Yeah, I mean, that's right. And so that's why we remain hopeful that the parties will resolve their issues. We trust their process to do that. Obviously, strike is a part of that too. And everybody would love to see a path forward where the union and the employers do the right thing. These are, a moment in which union members are seeing historic profits coming out from, a pandemic. I think the parties have to remain talking.
So to that point, do you think that the big three are negotiating in good faith? Sean Fain doesn't think so. Do you think so?
I'm not at the bargaining table. I'm not there. I do think that some of the, what gets said is reflective of what's happening at the bargaining table. Some of it is not, right? There's lots of things that happen during the process of a negotiation. I think it's important for us to allow the parties to do what they need to do, and that's that's what we're doing here.
I totally get it, and there is a process. But if President Biden is facing something like 3 big auto strike working, so 150,000 people maybe out of jobs plus, or 45% increase in wages. Both of those are difficult. On the one hand, you have a recession fear. On the other hand, that's going to lead to higher inflation with wages. Which side are you going to come down on?
Well, I think overall, right, as we talked about with the jobs numbers, we are seeing really solid job growth and a solid, strong economic picture. I think it's important not to make too much of any one part of that. And each time there's been a contract that is about to expire, there's been a whole lot of hand-wringing over what's going to happen. I think it's premature. I think the contract is not yet expired. It's important to allow the parties to do what they want to do. But I will say, this president, one of the pillars of Bidenomics is to believe that workers, an empowered workforce is a good thing for working people. And that is something that he's been unwavering about.
So that really does feel like support the wage gains, even if it might come at the expense short term of the economy. Is that a fair characterization?
Well, it's really about supporting the parties negotiating in good faith to grapple with hard issues and arrive at a place where, the president often says, when workers do well, employers profit, and the economy is stronger. That's what we'd like to see.
But before I let you go, and I'm saying this in jest, but I actually mean it, Taylor Swift has truly driven the economy in many ways. Just look at AMC. And I'm wondering, do you talk to Taylor Swift? Like when she stops going on tour, are you actually going to be looking at like a weakening labor market and a weakening economy? I'm joking, but I'm also kind of serious.
Right. So I'll respond. Women are powering this economic recovery. Women are at the highest levels of, percent of women in jobs for the 5th month straight, record-breaking. And remember, during the pandemic, women were really devastated by, the lack of paid leave and the lack of care. We've seen women come back in really high numbers and get jobs, and we need to continue with that trend of making sure that women get to participate fully in the economy and the good jobs that are being created.
Yeah, I don't think Taylor Swift had a problem with that. I don't think her roadies, though, are women, but okay. Thank you very much, Secretary. Appreciate it. Julie Hsu, Acting U.S. Secretary of Labor. All right, coming up, President Biden preparing to deliver remarks following the latest payrolls report. So that conversation coming up next with iCapital's Anastasia Amoroso and PGIM's Michael Collins. This is Bloomberg.
This is Bloomberg's The Open. I'm Simone Foxman, and you're looking live at the Principal Room. Coming up, an interview with CoinRoot's CEO David Weisberger. That's at 1:30 p.m. New York time, 6:30 p.m. in London. This is Bloomberg.
This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you want to see in a strong economy.
That was Acting Labor Secretary Julie Hsu making the case for Biden economics following today's jobs report. The president also facing surging gasoline prices ahead of the upcoming election. That's not a good combo. Let's go to Anne-Marie Hordern in Washington for more. Anne-Marie?
Yeah, Alex, when it comes to the jobs and inflation question, this is something the president has been struggling with because when you look at the polls, while his overall approval rating is north of 40%, it's much lower when you look at where this president is rating when it comes to economic issues. And now, while we have seen a strong labor market, there's things today that the president is probably going to nitpick out and want to really try to assuage American concerns, like the unemployment rate that has ticked up. The president is likely going to say that this is the 19th month in a row that you still had the employment rate under 4%. And also, while the unemployment rate did tick higher, it did drop for Black Americans, something the Biden administration is certainly going to want to tout as they campaign for the presidential election in 2024. The biggest issue, though, facing this president, Alex, as you know, is not the job market, and that is inflation. And as long as inflation continues, at least the rate of inflation continues to come down, that will help them along the timeline of the election of next year. But really this, when you look at what gas prices are now, but still Americans are still complaining about higher food prices, higher rent, that's really the crux of the issue.
Yep. And then maybe some worker strike in the auto industry. Anne-Marie, thanks a lot. Appreciate it.
Yep,
so with me, Anastasia Amoroso and Mike Collins joining me here. Hey, Anastasia, and thought on both of you guys for this. Anastasia, are we at a risk here for like a serious auto strike? And sort of how are you thinking about that? Question for both of you guys. But Anastasia, go first.
Yeah, Alex, I think you brought up some really good questions during the interview. And, you know, the thing that really stuck out to me is, you know, let's say we do end up averting the strike, but there is this real wage pressure that is happening in the economy still, because with the labor market being as tight as it is, not enough workers available for some of the key industries, you definitely have the ability to, you know, for this collective bargaining power to generate wage gains. And you know, that poses a two-way problem. And of course, it has its benefits as well. But the problem is that this 4.3% year-over-year wage growth may actually stay around these levels if you continue to have this sticky wage pressure. So I think that's a real concern in the market. But the other thing, Alex, is I think is going to push more and more companies to look at what they can do in terms of investing in technology and investing in artificial intelligence to potentially circumvent some of the wage pressures that are building otherwise.
Yeah, although then unions won't like that either. Mike, what do you think?
Yeah, I mean, these headlines of these huge wage gains the unions are garnering are really eye-popping, Alex. But, you know, we've actually parsed the data. You know, unions are only 5% of the private workforce now. And even if you take these big, you know, headline wage gains, it's barely a rounding error in terms of impacting the overall wage gains. And you know what? Forget about Taylor Swift. I mean, this old Jersey boy is heading to the swamp of the Meadowlands today to tailgate and see the original boss, Bruce Springsteen.
Okay, well, fair enough, but come on. Taylor Swift had like a record-breaking tour. I mean, sorry, boss, but it ain't the same, Mike. He's gone. He doesn't want to talk to me anymore. Okay, well, that's fair enough. Guys, we're going to leave it there. We appreciate it. Anastasia Amoroso, Mike Collins, who doesn't want to talk to me anymore over Bruce Springsteen. All right, coming up at the market-moving events you need to be watching. That is coming up next in our trading diary. This is Bloomberg. 30 minutes into the open here on this Friday. I gotta say, we're losing a little bit of steam. The S&P now up just 0.3%. The Nasdaq now flirting with negative territory as front-end yields move much lower. You still have a nice solid rally here with the Russell, but I want to point out the bond market because yields in the long end are ticking higher. The front end is still lower, but that's just by 3 basis points. So we are losing a little bit of this steam. The 30-year, I should point out right here, down by about 6 basis points. The best performing sector so far in the S&P is energy, and that's because oil continues to hit that level that we haven't seen since November of last year, but the dollar also just flipped into positive territory, so you have to wonder how long that move is really going to last. All right, let's wrap it up now with the trading diary. This is everything you need to be watching this week. So U.S. markets are closed Monday for Labor Day. Have a wonderful day off, everybody. We're also going to get factory goods and durable goods orders on Tuesday, so keep your eye out for that. Then Wednesday, lots of Fed speak from Collins and Logan, plus the Fed releases its beige book. And Thursday, we're going to hear from Harker, Williams, and Bostic. Plus, another round of jobless claims. Will they support this solid job market? Let's get right back to those numbers here. Non-farm payrolls coming in better than estimated, 187,000. If you were backing out the yellow truck bankruptcy and the workers, it would be even hotter. You also have the unemployment rate moving higher to 3.8%, but because the labor force participation rate also moved higher, and that is a good thing. You have hourly earnings on a year-on-year basis coming in 4.3%. Goldilocks. Markets taking it as Goldilocks. This is the countdown to the open. This is Bloomberg.